Hello, and welcome to Fixed Income Portfolio Construction. We know that this is a tricky time to be a bond investor. This presentation has been developed to give you the tools and techniques that you need to navigate today's fast-moving investment landscape and build robust bond portfolios. We are going to touch on three topics. One, the markets. Two, asset allocation and portfolio construction. And three, manager selection. And let's start where we as bond investors often start, and that is by looking at the interest rate paid on U.S. government bonds. This chart shows you the yield on the 10-year Treasury note going back to the early 60s. As you can see, interest rates are pretty low from a long-run historical perspective. Not quite the low for the series, but close. And in a world where yields are low and cryptocurrencies and the like garner more attention, some investors may ask themselves, well, do I still need bonds? One answer to that perhaps lies in this quote from cowboy philosopher Will Rogers, who reminded us that sometimes we should be more concerned with the return of my money than the return on my money. U.S. government bonds, for example, are still viewed as among the safest and most liquid investments in the global financial markets. There are high-quality bond issuers in the corporate and mortgage space too. But what about the risk of higher rates? Don't bond prices typically go down when interest rates move up? Yes, bond prices can go down when yields move up. But there is an underappreciated benefit to investors from higher interest rates, sort of a silver lining. The potential upside of higher yields is higher yields. Let me give you an example of that. Here in green, you see the 3-year annualized returns for investing in the stock market, represented by the S&P 500 over different periods going back to 1975. In blue, you see the corresponding returns for the bond market, represented by the Bloomberg Index. As you would expect, stocks have outperformed bonds over most 3-year periods. The green line is generally above the blue line. But the other important takeaway here, if you look really closely at that blue line, is that historically it has been really difficult to lose money in a high-quality bond portfolio if you hold your investment for 3 years. This was true even in the early 80s when Paul Volcker, who ran the Fed at the time, was trying to break the back of inflation by hiking interest rates. In the bond market, if you have a tough period when rates rise, in the subsequent period, you may benefit from those higher rates. Let's dive a little deeper into portfolio construction. In the context of a portfolio, bonds potentially play 3 roles. 1, defense, to protect principal. 2, to generate income from their coupons. And 3, to provide diversification. Historically, bonds zig when other markets zag. But it is important to note that how you emphasize those 3 potential benefits may vary depending on the risk tolerance and goals of each individual investor. And this is one of the secrets to effective bond portfolio construction. Let me give you an example. Let's take a look at the asset allocation for a growth investor on the right-hand part of this page. Is our main focus for this investor trying to maximize the yield on a bond investment that only represents 20% of the portfolio, perhaps by investing in riskier securities? Not necessarily. What might work better here is to allocate to a high-quality core bond portfolio that provides diversification when your equities sell off, given that stocks are your return driver in growth portfolios. How about an investor that's positioned the opposite way? The income investor on the left-hand side of this page only has 20% in stocks. With this investor, we may want to focus more on generating yield in that fixed income bucket and, importantly, diversifying within that bucket. Let's drill into that a bit further. Here on the vertical axis of the table, you see the names for different asset classes within the bond market. You have core, which includes allocations to government bonds, and you have international, etc. In the columns, you see yield, you have annualized volatility, you have correlation to the equity market, and you have the historical max drawdown. Just looking at a few numbers, you see, for example, that core bonds shown in the top row have a moderate yield. Call it 1.6% in this example. But core bonds have historically had a low to negative correlation to equities. That makes them a very appealing diversifier in a portfolio context. On the other hand, at the bottom of the table, high yield bonds, as the name implies, have a higher yield at 4.5%, but they have historically been more volatile and more correlated to the equity market, making them a bit of a less effective diversifier for, say, a growth portfolio. Understanding these sector correlations, yields, and drawdowns is important, as these are the building blocks that we are going to use to build real-life portfolios. Here is one example. Cheryl and Tom have been saving up for their young daughter's education. Their daughter is still 9 years away from college, and they have a balanced asset allocation. How would we construct a bond portfolio for Cheryl and Tom? Here it really is about balance. We want to emphasize the diversification benefits of bonds, and as we just saw previously, an allocation to core bonds potentially gives us maximum bang for the buck in terms of diversification to equities. As a result, for Tom and Cheryl, intermediate core bonds represent our largest allocation. We would also complement that with some international and corporate bonds. Next, we have Chris and Joanna, a young couple that is saving up to buy their first home in 12 to 24 months. Here, a longer maturity core bond allocation might not be the best answer given the possibility of negative returns if interest rates move up over the next 12 months. Chris and Joanna need something more defensive. But if you get really defensive and put them in a zero-yielding cash, then you lose any opportunity at generating a positive return or keeping up with inflation. The sweet spot here is likely a short-duration bond portfolio that generates more yield than cash, perhaps 1% or more, but has less interest rate risk than a core bond portfolio. Okay, we discussed picking asset classes. Now let's discuss picking actual funds. And on that front, we'll just start by noting that investing in bonds can be challenging. A large company may only have one class of common stock outstanding, but can have dozens of different bond issues around the globe, each with different terms, currencies, and legal protections. As a fixed income investor, you need resources to conduct this in-depth global research and pick these bonds. The upshot here is that because of these challenges and resource requirements, active management can work really well in bonds. Here you see the historical track record for active management in different Morningstar fund categories. 84% of active bond managers in Morningstar's intermediate core and core plus categories outperformed the median passive fund over a 10-year period. In the ultra-short bond category, 97% of active bond managers outperformed the median passive fund. In conclusion, this is a tricky environment for bond investors. Cash investments yield little, close to zero. Other bond sectors may pay higher yields, but you have to be more deliberate about how you incorporate them into your portfolio. In Cheryl and Tom's case, for example, we learned that core bonds provide nice diversification to the equity risk in their daughter's 529 plan. We also saw how Chris and Joanna emphasized short maturity bonds as they saved up for a down payment on their first home. Lastly, we saw how active management can be really effective in fixed income given the diversity and complexity of this $114 trillion global market. For more information, please contact your account manager or visit us at pimco.com/advisoreducation.